Good day, everyone. This is Jason Trennert, Chairman and CEO of Strategas, the investment strategy arm of Baird. With the renewed selling pressure in both the equity and fixed income markets, I wanted to take a brief moment to address the volatility, how it affects our outlook for markets, and what it means for you. So at Strategas, I don't think we quibble with the idea that there is a chance that inflation has peaked. After all, you've seen a big increase in mortgage rates, which will likely lead to a decline in housing prices, and you've seen some other items like used car prices come off the boil. Having said that, there are a number of items out there, whether it's wages or energy prices, that we think are more structural in nature and will keep inflation higher for longer, perhaps, than the consensus believes. I think more importantly, it's really what the Fed believes. And it seems clear based on the Fed's comments and the Fed minutes that came out that the Fed is deadly serious about addressing inflation. We see really very little wiggle room in the comments from Fed members about their commitment to controlling inflation. So to us, it's still going to be a difficult slog for investors to get through. Well, at Strategas, our chief economist, John Rissmiller, has the odds of a recession at about 50% in 2023 and 50% in 2024. So just doing the quick math there, that strikes us that the odds of a recession are about 75% at some point over the next 2 years. So the odds are pretty high, in our opinion, that you'll have one. It's very rare, actually, that you get the so-called soft landing that everyone is looking for. Most of the time when the Fed is tightening, when inflation is this high, it's very, very hard to nuance things enough so that you don't have a pretty meaningful recession. Having said that, I would say the starting point is a bit better than what we've seen in any other recession, which is to say you're close to full employment at 3.5%. And so it doesn't necessarily have to be as deep as it was in years past. There is a chance that we can get through what we think will likely be a recession with a terminal unemployment rate of something below 6%. And of course, it's tragic when anyone loses a job. No one wants to see job losses. But in comparison to history, I think we would consider ourselves relatively lucky if we could get through a recession like this without the unemployment rate much above 6%. I have to think that it's likely that you're going to have a difficult period of time for equity returns for the next couple of years. This year, obviously, is a terrible year. Next year will unlikely be as bad as this year, but I also think that returning to double-digit types of market gains is unlikely until we go through this cycle, until we go through what is likely to be a recession, and until the Fed is at a point at which it can actually start easing. It's very rare, it's never happened that you've had a recession in the economy without having a meaningful decline in earnings. On average, that decline is 30%. This time it may not be quite as deep because inflation is a bit higher, but we do think it's also going to be difficult to get multiple expansion in this period without the Fed actually getting to the point where it might ease. So ultimately, this suggests to us that you're going to have a continued difficult time in achieving positive or certainly double-digit types of returns in the equity market. Well, it's a great question, and I have to say one of the hallmarks of what we do at Strategas, I believe, is that we're quite humble in our forecasts, which is that we've been doing this so long that we remember well the times when we haven't been as accurate, and what we try to do is take in all new information and change when the facts change. What those facts, as we see it, that would lead us to be more bullish would be a significant decline in inflation, a more dovish Fed, and there are other items that could be more bolt from the blue items that could help us get more bullish. I think particularly a different attitude among industrialized countries regarding energy policy would, in our opinion, do a lot to take the temperature down in terms of the chances of recession. And that means if we took maybe a longer term perspective in the transition to renewables, and we're not so willing to eschew fossil fuels, that might make it a little bit easier, I think, for us to weather this storm. But those are the things that we would look for to get somewhat more constructive on the markets. Of course, the markets will start to bounce before the depths of the recession are over. Market is a discounting mechanism. Unfortunately, we still think there's some time left before you see that kind of turn in either the inflation data or the attitude of the Federal Reserve Board. Well, in the end, I just wanted to thank everyone for spending so much time with us today. And we really very much at Strategas and Baird, Strategas is a Baird company, we very much appreciate your support of our firm. And rest assured that we're paying close attention to these developments in the economy and in the financial markets to keep you apprised of the latest changes in our thinking.